Hello, everybody. This is Rick Geiler with SilverSide Insurance Marketing here in Tempe, Arizona. And for today's presentation, we are going to talk about the current interest rate environment and how that pertains to our business and some of the issues we are facing. I have on the line with me Tony Filarillo. He's the president and founder of Asset Management Strategies in Indianapolis, Indiana. Thanks for being with me today, Tony.
Thank you, Rick. Appreciate it.
Okay, so without further ado, we'll just get going here. I know you have a few slides prepared, and you've got a few takes to show our folks on those.
Okay, thanks, Rick. We wanted to talk a little bit today about the current interest rate environment. There's a lot of volatility in the stock market, leading, I think, through some of the conversation that we've heard around the Fed's upcoming meeting on the September 20th and 21st, where there's speculation that they might raise interest rates. I don't know that there's really justification for raising interest rates. The Fed usually raises interest rates because they're trying to slow down runaway growth in the economy, which we certainly don't have, or because they're trying to stave off inflation, which at this point we don't have. The argument has always been that we're going to see inflation now that we're at full employment, and people are only going to change jobs if they can make more money, so that there's going to be wage inflation, and that's going to lead to overall higher incomes, and that's going to lead to overall higher inflation. But we haven't seen that yet. I think the technology keeps that somewhat in check as people become more efficient. Some of those jobs don't necessarily get replaced when they leave. So, but we did want to talk a little bit about global approach to interest rates. Everybody, I think a lot of agents are hearing from clients that they're sitting, not doing anything because they're waiting for interest rates to go back up. And I think that there's one very important slide that I've seen in the last couple months that I thought was just remarkable. And I pulled that slide up here. This is world interest rates, global interest rates for countries that issue government debt at the end of June. So if you look at the color-coded nature of this, all the ones in red are negative interest rates, and they show these as 1 year, 2 year, all the way up to 30-year government bond issues. So if you focus in on the 10-year government bond issue, where you're looking at the first three are negative, which is Switzerland, Germany, and Japan. The next ones in yellow are at less than 1%. Then as you go down this list, you see finally the United States here, almost at the bottom. The only one below us is Portugal. So what that means is that Portugal is paying 3% on a 10-year government-issued bond. The United States 10-year Treasury at the time, at the end of June, was 1.47. Right now it's about 1.6, so it's gone back up a little bit. But and it's got the United Kingdom here, which actually should be yellow because that yield is less than 1%. Then you've got Spain and Italy and Spain, which are not necessarily what I would consider to be the most stable economies and the most stable currencies. So you have what is called the PIGS, which stands for Portugal, Italy, Greece, and Spain, which are sometimes used in derogatory terms as far as the quality of those economies. And yet those are the ones that are competing with us for the highest interest rates. If you take the outlier there, Portugal, out of the picture, that leaves us at roughly 1.5%, 1.6% right now. Everybody else is significantly lower than that, even in the category of Spain and Italy and the United Kingdom. Then you get back up here to the other categories where you've got the most stable economies, the most stable currencies with Japan, and then of course with the euro you've got Germany and Switzerland at the top. But these are negative interest rates, and the European Central Bank just last week went to negative interest rates. I think the UK is going to lower their interest rate again. So believe it or not, at 1.5% on the 10-year Treasury, I think that there is a very, very strong argument for our interest rates going even lower, despite what the Fed says. Despite the Fed saying that we're going to raise interest rates, we could see this 10-year Treasury yield go lower still. And the reason I say that is because just between just between Switzerland and Japan, there's $13 trillion that is sitting, paying every night to be safeguarded in a bank. Negative interest rates mean that they actually have to pay the bank to keep their money. I don't know how long those people are going to keep doing that before they look over at the United States at 1.5% and think, man, that doesn't look too bad. So going back to June of this year, which this chart is at the end of June, in June we had the British exit and all of the upheaval over that. And at that time, the dollar rose very substantially, and the 10-year Treasury yield went down because people were buying the Treasury bond. When they buy the bond, the yield goes down. We got down to, I believe it was 1.38% yield on the 10-year Treasury, which is the lowest that yield has ever been in history. So in that micro panic of time, which at the time was not such an easy period to identify, but in that couple days of panic with the British exit, what did world money do? It fled immediately to the United States. It bought treasuries and it bought U.S. dollars. So as many problems as we still have on a fiscal front here, we are still the most attractive safe haven for money from a currency and government bond issue standpoint. I thought that this was remarkable, and I think that if agents are talking with clients and the clients are saying, I'm waiting for interest rates to go up, I think you could pull this chart out and say, I don't know what's going to happen with interest rates, but I think that there's a good argument for the fact that interest rates can stay low and potentially go even lower. Now, to the consumer, to the average investor, I don't know that they think that interest rates can go lower because they're getting 0.1% on their savings accounts, checking accounts, money markets. So for them, it can't go lower, but it really can. So, in essence, you could actually go to a negative interest rate, even on a 10-year issue. So I think that this is at least worth having a conversation with these people that are not taking action because they think that interest rates are going to go up. And now that they think the Fed is going to raise interest rates, they think that that's going to save them. There's also some pretty strong argument for the fact that we carry the largest government debt that we've ever carried in the history of this country, and to whatever extent the government has the capacity to manipulate our interest rates, it certainly is in their best interest to do that. We have a very large portion of our budget that is spent on interest rates right now on our government debt, on our current government debt. If those interest rates go up, then that same level of debt costs us more money, and that has to come out of the budget somewhere else, or we just have to borrow more money to continue to feed that beast. And that doesn't even address the issue with the continually increasing government debt. So suffice to say that if the government has the capacity to keep interest rates low, they are certainly going to do that as best as they possibly can. I think another interesting way to look at this is if we look at the what is called the M2, the money supply, we are right at about $13 trillion. This chart shows starting back in 1959, I believe was the earliest date of this, where this money supply number was. And as you can see, this number has increased very smoothly throughout the history of keeping track of this. And money supply, M2 money supply, is basically any deposit dollars that are in short-term bank deposits. It could be in money markets, it could be in checking accounts, it could be in savings accounts, it could be in short-term CDs. They add all of that up, which is basically thought of as pretty much liquid money, and they keep track of that number. We're at the highest point that number has ever been. A couple things that I think are interesting here is that if we go back to 1980, where in early 1980s, the 30-year Treasury was paying over 15%. We had a flat yield curve. Money markets were actually paying 15%. Depositors think of those as the good old days. If you were a consumer buying a car and paying 18% interest, or buying a home paying 18% interest on your home mortgage, you didn't think of those as the good old days. But isn't it interesting that we didn't have a substantial increase in this money supply number during that time period? You would expect that with that high of interest rate, that you would have seen a pretty pronounced blip in this money supply, that there would have been a lot of money coming out of equities or anywhere else that it could come out of to go into the money supply at 15%. And we didn't really see that. We saw a very gradual, very reasoned increase to these interest rates across the time. The other thing that is interesting is I think that you do see a little bit of an increase in the slope of this rate since 2000. And it was kind of a slow, gradual buildup of just money on the, what is thought of as money on the sidelines. But after 2002, the steepness of this has increased pretty substantially. And I think that that's because you've got a general concern over the equity markets. Some would even say an apathy or distaste for the equity markets. And I would say my argument to those people would be that I can't blame you a bit for not liking the equity markets the way that we have traditionally invested in equity markets. If you're in the equity markets with a buy and hold mentality, I think they're a very, very dangerous place to be. Our approach to money management is that we use a tactical approach. It's really a trend-following process that would potentially go to a zero allocation in equities when we get the signals to do so. So our software, our algorithm, could potentially have us 100% out of the equity markets. If I did not have that tool, quite frankly, I don't know that I would want to be responsible for people's money, and I'm not sure that I would want to be in the industry, because I think there are very, very scary things out there that can happen relatively quickly that can affect the values of those equity markets. So as we look here, the M2 dollar amount is roughly just about $13 trillion as well. So when you think about the $13 trillion that we have sitting on the sidelines, you think of the $13 trillion just in Japan and Switzerland, not counting all of the other European currencies, Germany and so forth, where there's still significant wealth in those areas. There's a lot of money that is making little or no return. So why isn't that money flooding into the stock market? I think that we're just at a point where people are very suspicious of the stock market, and we just have to live with that. We have to abide by that. But if you've got clients that are not willing to commit to an annuity because they think interest rates are going up, I think this makes a compelling argument for them not waiting any longer. So that's pretty much all I had. Just wanted to kind of touch base on where we saw interest rates. I think these two charts are very interesting. I know that Rick has the ability to put these up on the broadcast, so we'll make these available to you if you'd like to print these out and use them for your own use, but I thought this might be helpful to you. So that's all we had today. If Rick, you still there?
Hey, that's great information, Tony. Thanks for that. And yes, we can get that fidelity sheet available, and it could be a useful piece for you guys out there in the field. If you would like to know more about partnering with Tony and AMS, go ahead and give us a buzz, and we can get you the details on that. Or for any of your life and annuity needs, go ahead and call us 480-998-1286. Thanks for being with us today.